Dear friends, welcome to the November edition of Monthly Viewpoints. During the month, we have seen that almost all the major global markets have hit all-time highs or at all-time highs. This is primarily because of the synchronous global growth which we're experiencing both in the developed markets as well as the emerging markets. If you look at the data points like the corporate earnings or financial data points or the sentiment indicators, they all point towards the synchronous growth between DMs and EMs. After 2 months of hiatus, we have seen that the large cap index Nifty has come back strongly with a performance of 5.6% during the month. And we have seen that as you go down the risk curve, the returns have been better. If you take the mid cap index, it has outperformed the large cap index by 250 basis points, clocking 8.1% return. The small cap index has clocked a return of 12.6%. After the 2 months of hiatus, we have seen that Nifty has bounced back strongly with a return of 5.6%. And if you go lower down the risk curve, the returns have been much better. If you take the mid-cap index, it has outperformed the large-cap index by 250 basis points, clocking a return of 8.1%. The small-cap index was stupendous with a return of 12.7%. If you take gold, which is supposedly risk-averse investment, has clocked a negative return of 1.9% in INR terms. On the currency front, India stands out as one of the very few nations which has bucked the trend of a strong dollar, and it is appreciated against it by 1%, primarily because of the hawkish stance which RBI has on cutting interest rates. In terms of flows, we have seen that all the three institutional categories have been net buyers. If you take FIIs, they have come back with a net figure of $295 million of purchases after selling $3.3 billion for the previous 2 months. But having said that, they have been participants in the primary market. In terms of mutual funds, the buying spree still continues and they bought about $1.39 billion during the month. The other DIIs bought about $160 million. We have seen that the primary issuances for the calendar year 2017 has hit over 1 lakh crores, and we see that a big pipeline of IPOs and FPOs and QIPs are in place and which will hit the markets in the next few months. On the global front, the new chairman for US Fed has been announced with the name of Jeremy Powell, replacing Janet Yellen, and he seems to have the same thought process as her, and there is going to be continuity of policy. The markets is giving a probability of 92% for a rate hike in December. The taper is on with the US probably cutting $10 billion in asset purchases. The ECB has announced that it's going to cut asset purchases from 60 billion euros to 30 billion euros starting January, and it might bring that down to zero by September of next year. Though support will be provided in case of slower growth. Post the 19th Congress in China, there is expectation that the credit stimulus which the country has got over the last few months might decrease. So there's an increasing worry on decreasing liquidity going forward globally. Does it affect the markets? It's a function of growth which the markets are seeing in terms of economic growth. If the economic growth sustains, then the correction which has been evasive for quite some time can still be so. Domestically, we have seen that the government has been nimble-footed in taking actions, especially on the GST front. Because of a lot of feedback which they have got, they have changed the rate structure of a few sectors which are primarily affecting the SMEs and MSMEs, which cover a large part of the broader economy, and then the markets hope that they're going to do more if required going forward. In terms of earnings, we have seen that the earnings surprises have been good. Over 40% of the Nifty companies have beaten the expectations. Only 20% of the Nifty companies have been below expectations, and this number used to be in the range of 40 to 50% for the last 3 quarters. Remember, only 70% of Nifty companies have announced result. There are 30% more to go, but the initial indicators are such that there is going to be broadly good numbers which you're going to see, and H2 of this year is where we can see the revival of earnings which you have been long expecting. Coming to the view, as we have been sharing, data because of the GST implementation could be hazy. So this month the PMI number on manufacturing was weaker, but the PMI number on services was good. The quarterly results indicate that the consumption numbers of most of the consumer companies, volume growth has been good. But the auto numbers which you have seen last 2 months, this month has been a little weaker. So we would advise that it would take some time for the GST numbers to stabilize. But we hope that this particular implementation will see growth normalizing in the next few months, as well as increase in tax revenues, which we have been long expecting. will come back. So it's just a matter of few months for the normalization of the effect of GST to take place. One of the questions which investors would have on the top of the mind is when would markets correct, which is a very, very difficult question to answer, is because markets have been very quick at discounting negative news flow for the last few months. That's because the strong domestic liquidity which is there, the strong global liquidity which is there. So we believe that until and unless there is a huge exogenous event like that of a geopolitical fallout or a corruption scandal which is breaking out, or oil breaching a higher number of maybe 65 or 70, we don't see the correction could come. However, we say that I think any given weakness in the market should be bought into by investors, but having said that, investors have to be sticking to their asset allocation, rebalancing their portfolios because of the kind of performance which you have seen in the recent months in the markets. We see that we are at the bottom of the cycle. The earnings rebound is happening. We still have a double-digit earnings growth for FI 18, and we see that the momentum could continue for the next 2 years. So if somebody is investing with a lower double-digit kind of written expectation, he or she would not be disappointed for the next couple of years time frame. So we have a whole host of products available in our equity basket, right from our large cap funds, our multi-cap funds, our balanced advantage fund which has low volatility, balanced fund which is a mix of both equity and debt. So these are the kind of products which you can buy into in case you would want to get a piece of equity. From the debt view standpoint of view, our team still believes that there is a scope for policy rate cuts going forward because of weaker growth, stabilizing inflation, removing the statistical part of HRA component, then higher real yields which is being provided in the market. So these three factors would compel the RBI to cut rates further. So those who have been invested in duration funds, please continue to do so. Our Income Plus and Dynamic Bond Fund are having reasonable duration. Those investors who would want low volatility could look at our accrual funds in the form of Corporate Bond Fund, Medium Term Plan, and Short Term Opportunities Fund. Thank you and happy investing.